So we have talked about consolidation entries TI, G, and star G. We have also talked about how to allocate consolidated total net income when there's intra-entity inventory transfer. Now let's look at how to put them all on the consolidation worksheet. So if you go on Island, you should have seen a handout uploaded in your Island. And this handout is basically made up of 4 consolidation worksheets. So those it is a downstream transaction, and if the parent is using the equity method. The second situation is if it is upstream, the parent is using the equity method. The third situation is if it is downstream, the parent uses the initial value method. And the fourth situation is if it is upstream, the parent uses the initial value method. So if you look at these 4 consolidation worksheets, the first column of each of those worksheets, which is the parent's book. So as a reminder for you, a consolidation worksheet is basically we take the parent's book and we take the subsidiary's book. We make all of the consolidation entries that we need to make, including we need to calculate the net income allocated to non-controlling interest. And then we kind of add them all together, and that will give us the consolidated total numbers. So the first column on each of the worksheets, which is the parent book, it is just literally taken from what you have done in class 8, which are each of the columns here. So if you still remember that in class 8, we talked about how to make the parent kind of how to take into consideration the journal entries made on the parent book and then to complete the parent book. So each of the column, the first column on each of the worksheet is just taken literally from each of the column in your class 8. So let's first look at the first situation. If it is downstream inventory transfer and the parent is using the equity method. So in this situation, if you remember that the star G entry, so first let's write out, this is for the year 2015. So this is for the year 2015. And because in 2014, we have an intra-entity transaction. And then as a result of that intra-entity transaction in the year 2014, we need to make an entry G. And then that entry, so we have already calculated here. That entry G is literally, we need to defer the remaining, the profit associated with the remaining inventory, which is 4,000. So the G entry in 2014 is to debit cost of goods sold. For 4,000, credit inventory for 4,000, right? And then so because we have a G entry in 2014 and the star G entry, so that we need to have a star G entry in 2015 to both carry over the effect of that 2014 G entry and also to reverse it when the deferred profit is really recognized in the year 2015. So because the parent is using downstream equity method, so the general entry star G is to debit investment account for 4,000 and to credit cost of goods sold for 4,000. So after we have put star G entry, because the parent is using the equity method here. So we do not need any star C entry. And then we can just go directly into SAIDE entries. The S entry, the purpose is to eliminate subsidiaries shareholders equity account. And we can see here the subsidiary has beginning retained earning of 310. To reverse it, we debit 310. Subsidiary has common stock 150. To eliminate it, we debit 150,000. And then, so this 310 and 150, it is allocated between non-controlling and non-controlling interest. Controlling interest has 80% ownership in the subsidiary. So the controlling interest gets 80%. So 80% of that is 368,000. So investment account goes down by 368,000. And non-controlling interest is allocated 20% of this. So non-controlling interest gets 92,000. So this is consolidation entry S. Consolidation entry A, the purpose is to mark up subsidiaries' book value to fair value. And then because we already have 1 year before that, the original difference between book and fair value is 50,000. And each year, the amortization is 2,500. So after 1 year, which is year 2014, the remaining difference between fair and book value becomes 47,500. So we mark up database by 47,500. And this is allocated between controlling and non-controlling interest. Controlling interest get 80%, non-controlling interest get 20%. So for the controlling interest, the investment account goes down by 38,000. For the non-controlling interest, gets 9,500. So this is consolidation entry A. Consolidation entry I, the purpose is to eliminate the subsidiary's income recognized by the parent. So as we can see here, parent, so this blank page, I haven't filled in the parent book yet. So let's just move the what we get from your last class so what we finished in your last class to the first column in this page. Equity in subsidiary earnings is 52,000. So net income is 162,000. And then 162,000 here. So retained earning is 744,000. And this is carried over to a balance sheet. On your balance sheet, investment account is 414,000. So your total asset is 1,514,000. So this is just, we already went over this column in your last class. Now I'm just copying what we get from your last class to this column. Okay, so we have all of the number here. So consolidation entry I, the purpose is just to eliminate this number, 52,000, which is recognized by the parent. In order to eliminate this number, we debit 52,000 and we credit investment account for 52,000. Consolidation entry D, the purpose is to eliminate intra-entity dividend payment. And then because here, all of subsidiaries dividend payment is 50,000. And because the parent has 80% of that, so 80% of 50,000, that is 40,000. So the dividend goes down by 40,000. And then the investment account goes up by 40,000. Consolidation entry E, the purpose is to recognize the current year amortization. So each year amortization is 2.5 thousand, and database, it is an intangible. So it is recorded as amortization expense. And amortization expense is part of the operating expense. So here we just put it into the operating expense. So operating expense goes up by 2.5. Oh, sorry, not here. It goes up by 2.5 thousand, and database goes down by 2.5 thousand. Consolidation entry P, the purpose is to eliminate intra-entity payables and receivables. And we know from the program that there are 10,000 intra-entity receivables and payables. And those receivable and payables, they are recorded as receivables and payables on each individual firm's book. But if you look at two firms as one firm, there's actually no payable or receivable to any outside party. So this 10,000 should be eliminated. In order to eliminate this, we credit cash and receivables for 10,000. And we debit liabilities for 10,000. Consolidation entry T and consolidation entry G, we use those two entries to deal with the current year intra-entity inventory transfer. In other words, we use this to deal with the 20. So when consolidation entry star G is to deal with the 2014 intra-entity inventory transfer. T and G, those two entries are to deal with the 2015 intra-entity inventory transfer. So we know that in the year 2015, the total sales is 100,000. And then the remaining, so the profit associated with the remaining inventory, which should be deferred, is 6,000. So on consolidation entry TI, we use it to eliminate 100,000 intra-entity sales, overstated sales associated with the intra-entity inventory transfer. So we do that by debit sales for 100,000 and credit cost of goods sold for 100,000. And consolidation entry G is the purpose is to eliminate, to defer the profit associated with the intra-entity transfer. And in this case, the profit that needs to be deferred is 6,000. So we debit cost of goods sold for 6,000 and credit our inventory account for 6,000. So the last column is non-controlling interest. Here we start from the beginning non-controlling interest. We just add those numbers up. So that will give us 101.5 thousand. And then that is the current year net income that belongs to the non-controlling interest. So net income attribute to non-controlling interest, because this is a downstream transfer. So the intra-entity transaction, all of the profits are on the parent's book. It doesn't affect your subsidiary's net income at all. So we do what we did before. Subsidiary's net income is 70,000. Take out amortization, multiply by non-controlling interest percentage of ownership. So that will give us 13.5 thousand. So that is the profit that belongs, that is the net income, which should be attributed to non-controlling interest. And then non-controlling interest dividend is, so the total dividend paid out by the subsidiary is 50,000. Non-controlling interest has 20% of that. So non-controlling interest gets 10,000. And then if you add them up, that will give you the ending non-controlling interest, which is 105,000. And then the last thing to do is just to add up everything so that you can get consolidated total numbers. So we add up all of the sales number, that will give us 800,000. Cost of goods sold adds up to 402,000. Operating expense adds up to 222.5 thousand. And then your earnings in subsidiary income should cancel out. So that would be 0. And then your consolidated net income, if you add up everything, that will give you 175,000. So this 175,000, out of this 13.5 thousand belongs to non-controlling interest, which means the controlling interest is allocated 162,000. And this is carried over to your statement of retained earning. On your statement of retained earning, the beginning retained earning is 652,000. Net income is 162,000. And then your dividend is 70,000. So dividend, so as we mentioned before here, even though this 10,000 is rated as kind of the debit, but actually we should view it as credit when we add up everything on this row. Or we need to view it as, so we add up everything until here, and then it is allocated between controlling and non-controlling interest. So this we already talked about before, and then you add up everything vertically, that will give you the ending retained earning of 744,000. And this 744,000 is carried over to your balance sheet. On your balance sheet, the cash and receivables adds up to 390,000. Your inventory adds up to 374,000. And the investment account, if you add up all of this, that will give you 0. Net is 610,000. Plant asset is 360,000. Database goes to 45,000. And then if you add up everything, that will give you your total asset of 1,779,000. The liability is going to add up to 500,000. Non-controlling interest ending balance is 105,000. And common stock is 430,000. So your liability should add up to the credit side of 1,779,000. And the last check is your asset should be equal to your total asset should be equal to your total liability. So this is the first situation, if it is downstream and the parent is using the equity method. Now let's look at the second one. So again, the first column here, we just copy it from what we got from class 8. So here we have equity in subsidiary earnings of 52.4 thousand. So I'm just going to copy it from your last class. Okay, so this column just we're just copying it. And then here, so if it is upstream, the parent use the equity method. We first start from star G entry. So the star G entry here is a little bit different from the previous situation. In the previous situation, because if it is a downstream transfer, uh, so the profit was recorded on the parent's book, and then but instead of taking out it from the beginning return earning of the parent's book, because the parent has already done the work itself. So we need to reverse the investment account instead. However, in this situation, the upstream situation, the profit is recorded on the subsidiary's book. So what we need to adjust here is the subsidiary's beginning return earning. And no matter what the parent does, it doesn't affect. So the parent may have something on its book, but it doesn't affect the subsidiaries' return earning or anything. So what we did previously, the logic there does not apply here. So here, um, we debit subsidiaries' beginning return earning for 4,000 and credit cost of goods sold for 4,000. So this is what we do if it is an upstream transfer, the parent use the equity method. So because here, because it is an upstream transfer, so the profit in the previous year was recorded on subsidiary's book. And then, so here we need to take it out from the beginning return earning of the subsidiary. And then because the parent is using the equity method, so there's no star C entry need to be done here. And then we just go directly into SAIDE, so those kind of entries. And so for the S entry, we do the same as before. The purpose of S is to eliminate subsidiaries beginning shareholders equity account. And now, so a little bit change here is subsidiary has common stock 150,000. To reverse it, we debit 150,000. However, subsidiaries beginning return earnings is 310. And so star entry, one thing to remember is that your star entry always goes before all of the other entries. And then for the S entry, it is after we have recorded star G entry. So this 310,000, it is 4,000 of it is already reversed by your star G entry. So how much left do we have to reverse? Yeah, we only need to reverse another 306,000. So this is the little bit difference here. And then, so 306,000 plus 150,000, this is divided between controlling and non-controlling interest. Controlling interest gets 80% of that. So that is 364.8 thousand. And non-controlling interest gets 20% of that, which is 91.2 thousand. So this is S entry. And SIAIDEP, TIG. So all of those entries are essentially the same as what we did before in the previous page. So I'm not going to read through all of those. I'm just going to write it here. If you have any question, feel free to send me an email or ask me in my office hour. So we have filled in everything except the last two columns here. And then here, so for the non-controlling interest, we start from the beginning non-controlling interest, which is 100.7 thousand. So you add up those numbers. And then your current year net income attribute to non-controlling interest here is a little bit different from the previous situation because now we have an upstream transfer. So the profit is recorded on subsidiaries book. And then when we calculate the net income, which should be belong to the non-controlling interest, we should take out those intra-entity profit. And then also we need to add back the reversal of the intra-entity profit. So subsidiaries net income is 70,000. Take out amortization 2.5 thousand. Add back the previous years, the reversal, the intra-entity profit that we recognize in the current year, which was a result of the deferral of the previous year. And we need to take back the current year deferral of the intra-entity profit. And then multiply it by 20%. This will give us 13.1 thousand. And your dividend is 10,000. So your ending non-controlling interest is 103.8 thousand. And then for the last column, we just do what we did before. And I'm just going to write it here. And if you have any question, feel free to ask me. So 3 things to check about here. First, your equity in subsidiary earnings should go to 0. And then your investment account should go to 0. And then lastly, your total assets should be equal to your total liability and shareholders' equity. So this is the upstream, and the parent use the equity method. Now let's look at the third situation. If it is downstream transfer, the parent is using the initial value method. In this situation, let's first fill in copy the parent book from what we get from last class. So here, first let's look at star G entry. Star G entry here, because it is downstream transfer, so we need to take out part of the retained earning of the parent, and then to credit cost of goods sold. So we debit retained earning for the parent for 4,000, credit cost of goods sold for 4,000. And then because now the parent is using the initial value method, so we have another star entry to make here, which is star C entry. If you still remember what is the purpose of star C entry, so we have 650,000, which is the retained earning if the parent has been using the initial value method. And then we need to make it, convert it into the retained earning if it is downstream transfer, the parent has been using the equity method. So we can just take the number here, convert it into 652,000. Oh, sorry. So from a credit side of 650 to a credit side of 652,000. And we already have star G entry, which we have already debited 4,000. So how much should be star C entry in order to move it from here to here? Yes, in star C entry, we should credit 6,000. So that after those two entries, your beginning return earnings would get into 652,000. So star C entry, we credit 6,000 and debit investment account by 6,000. So another way to look at this is under the initial value method, we have 650 retained earning. And then this 650 under the initial value method, it is because it is counting all of the previous year's dividend as income. So we need to take out those dividends which are counted as income. And then if the firm has been using the equity method, it will need to record all of the previous year's earnings as earnings. So we add previous year's earnings, 30,000. And then we also need to take out amortization, 2.5 thousand. And then we need to take into account intra-entity deferred profit, which are 4,000. And because this is downstream, so we take 100% of that. So that will give you 652,000. So those are the conversion. And then for SAIDE, so for SAIDE, PTR, and G, we just do something very similar as before. Let me go through S with you, and for the rest, I'm just going to write, and I'm not going to go over those. If you have questions, feel free to ask me. So for S entry, we limit 310,000, which is subsidiaries beginning retained earning. And also we eliminate common stock, 150,000. We divide it between controlling and non-controlling interest. Controlling interest gets 368,000. Non-controlling interest gets 92,000. And for SAIDE, those are just what we did before, except it is under the initial value method. So we don't have D here because it has been taken care of by your consolidation entry I. Non-controlling interest. Non-controlling interest is affected only by downstream or upstream. So here, non-controlling interest is exactly the same as what you did in your page 1. And then the last column, you just add up everything in the way that we did before in what we did in your first page. If you add up everything, that will give you 175.5 thousand. So your last check is make sure that you shouldn't have any dividend income here. Your investment account should go to 0, and your total asset should be equal to your total liability and shareholders' equity. So this is the third situation. The last situation, it is upstream. The parent used the initial value method. So let me first just fill in the first column here. Consolidation entry star G. So now because it is upstream inventory transfer, so we need to take out retained earning from the subsidiaries beginning retained earning. So we debit subsidiaries beginning retained earning for 4,000, credit cost of goods sold for 4,000. And star C entry, so the purpose again is to convert 650,000 to what it should be if the parent has been using the equity method. And one thing to pay attention here is it is still an upstream transfer. And what the parent's beginning retained earnings should be if it has been using the equity method is 652.8 thousand here, because now it is an upstream transfer. It is different. So the parent's beginning retained earning under the equity method is different if the parent is using the upstream versus downstream transfer. So now it's just pay attention that the number we need to refer to is instead of 652, now it is 652.8 thousand. That is the same number as the parent used the equity method. It is an upstream transfer. So, and now because consolidation entry star G, it doesn't affect the parent's beginning retained earning. So there's no other, we don't need to consider star G here. The only entry here we're making is star C entry. And then we use star C entry to increase beginning retained earning by 2.8 thousand. So credit 2.8 thousand for the parent's retained earning and debit investment account by 2.8 thousand. So another way to look at this is parents beginning retained earning under the initial value method, upstream transfer is 650,000. And then take out 20,000, which was counted as, so under the initial value method, we count dividend as income. We need to take that one out. And then we need to add back the net income that should be counted as income. Take out amortization, which should be taken out under the equity method. And then we take out the intra-entity profit in the previous year. But in this situation, because it is upstream transfer, so we need to take 80% of that. And this will give you 652,000, 652.8 thousand. So those are consolidation entries, star G, star C. And then after those two entries, that is your S entry. Here, S entry, because we need to eliminate subsidiaries beginning shareholders equity account, and because star G entry already eliminated 4,000 of that, so we only need to eliminate 306,000. And then common stock 150,000. So 364.8 allocated to the parent and 91.2 allocated to sub. And then everything else is just like what we did before. Non-controlling interest is only affected by upstream or downstream. So here, this is the same as your page 2. And your last column, we just add everything up using the way we practiced a lot of times before. So the last check is make sure that your dividend income should go to 0, your investment account should go to 0, and your total assets should be equal to your total liabilities and shareholders' equities. So those are the 4 situations. And the last thing I want to do is I just want to do a brief summary of the situations we went through. Please do not look at this slide for now. Just please look at the consolidation worksheets. So yeah, let me just pull out the consolidation worksheets we went through just now. And please take 5 minutes. Try to think about, compare these 4 consolidation worksheets. And please tell me on this consolidation worksheets, what items, which columns are only unique to whether it is upstream or downstream, and which columns change depending on whether it is both upstream. So let me just write it down. So first of all, which columns only change whether depending on whether it is upstream or downstream. Columns affected only by upstream or downstream. And then the second one is, which are the columns? So compare these 4 worksheets, and then which are the columns affected by both upstream, downstream, and the method used by the parent. And then the third is, so which columns are just really similar? Columns that are similar. So including maybe in some situations, including those columns which only vary depending on the method used. So please take 5 minutes, compare these 4 worksheets, and then try to tell me which columns belong to the first one, which columns belong to the second one, and which column belong to the third one. You can pause your video for now. So columns only affected by upstream or downstream. So first, let's look at, this is obvious, right? Your non-controlling interest column. So I will just write it here, non-controlling interest column. Non-controlling interest column is only affected by upstream or downstream. It doesn't affect by the method you use. And then another column is obvious, that is your S column. Your S column is affected by upstream or downstream. So for example, in the downstream, situation, with debit beginning subsidiaries return earning for 310, and for the upstream we debit by 300, 306, and then here downstream 310, upstream 306. So your S column is also affected only by upstream or downstream. And then there's another column which is the consolidated total column. So that is consolidated total column. So this column, it is different either the parent is using the upstream or downstream. If you compare this column with the next page, your column next page, you will notice there's a difference. However, it is not affected by the method the parent used. So that is also one of the classification one. Columns affected by both upstream or downstream and the method used. Star G column, it is different. So we already talked about it before. And also your star C column is different. It differs by both the upstream, downstream, and the method used. And then everything else, all of the other columns are very similar to before, in the sense that they're either the same or They are only affected by the method used. So this slide basically sums up what we just talked about. Yeah, and this is the end of today's class. For next class, we're going to talk about intra-entity depreciable asset transfer and land transfer.